March 15th. Remember that date because it could go down in financial history as the day the silver market broke. We're not talking about a normal price movement or a typical market fluctuation. We're talking about a potential complete breakdown of the paper silver system that could send prices into the stratosphere and expose decades of manipulation. The evidence is mounting, the pressure is building, and smart money is quietly taking positions that could turn into generational wealth. If you're not paying attention to what's happening right now, you're about to miss one of the most significant wealth transfer events in modern commodity market history. This is not hype. This is reality unfolding in real time. Welcome to George Vance Live, where we expose the truth about markets that Wall Street desperately wants to keep hidden. If this is your first time here, smash that subscribe button and turn on notifications right now, because what I'm about to reveal could completely change your financial trajectory, but only if you understand it and act before the March 15th deadline. Let me start by explaining exactly what makes March 15th so critical, because the mechanics matter. This is the first notice day for the March silver futures contracts on the COMEX exchange. What that means is this is when buyers of futures contracts must declare whether they want physical delivery of the silver they've contracted to purchase, or whether they'll roll their position forward or settle in cash. Normally, this is a non-event. Most traders just roll forward or take cash. But this year, something fundamentally different is happening that's sending shockwaves through the commodity world. Multiple large institutional buyers have already publicly announced their intention to stand for delivery. We're talking about over 150 million ounces of silver that could be demanded for physical delivery. To put that in perspective, that's roughly 15% of total annual global silver mine production being demanded in a single delivery cycle. The COMEX registered silver inventory, which is the only silver available for delivery against contracts, currently sits at around 45 million ounces. You see the problem? There's nowhere near enough physical silver in the warehouses to satisfy the potential delivery demands. Now, the COMEX has dealt with delivery squeezes before by various means. They raise margin requirements to force leverage longs to liquidate. They encourage cash settlement at premiums. They allow warehouses to issue warehouse receipts that can take months to actually deliver physical metal. But this time, the buyers demanding delivery aren't speculators who can be shaken out. These are industrial users who need the metal for manufacturing, sovereign wealth funds making strategic commodity allocations, and large institutions that have specifically targeted this contract expiration as a way to expose the paper manipulation scheme. They're not backing down. Here's where it gets really interesting. The silver market has been the subject of manipulation allegations for decades. Former traders have come forward. Lawsuits have been filed and settled. Even regulatory agencies have fined major banks for spoofing and manipulation in the silver market. The scheme works like this. Large banks create massive short positions in paper silver futures, far exceeding any physical silver they actually hold. This artificial supply of paper silver suppresses the price. They make money on the short positions and also help other divisions of their banks that need low silver prices for various reasons. The manipulation works as long as most futures contracts settle in cash, and nobody demands a large-scale physical delivery. But when significant buyers start demanding physical metal and the vaults can't deliver, the entire fraud gets exposed. Prices have to rise dramatically to either attract physical silver from other sources or to convince the buyers to accept cash settlement instead. Either way, the manipulators lose and the price explodes. This is exactly what happened with palladium several years ago, with nickel in 2022, and it's what appears to be setting up in silver right now. Let me walk you through the evidence that this squeeze is real and building. First, look at the physical market disconnect. When you go to buy actual silver coins or bars right now, you're seeing premiums of $4 to $6 per ounce over the spot price, and in some cases even higher. Spot silver is trading around $25 to $26, but you're paying $30 to $31 for physical product. That's a 20% premium, and it's been persistent for months. Delivery times have stretched out to 4 to 6 weeks for many products. Some dealers are simply out of stock on popular items. This tells you that the physical market is extremely tight, while the paper market still shows relatively calm prices. That divergence can't persist indefinitely. Eventually, the paper price has to rise to match the physical reality, or the physical premium has to compress. Given the delivery pressure building for March 15th, it's far more likely that the paper price rises dramatically to close the gap. When that happens, anyone holding physical silver or positioned in silver investments is going to see substantial gains. Second, look at what's happening in the mining sector. Silver mining stocks have been showing unusual strength even when the silver price itself is flat or slightly down. This is often a leading indicator that smart money expects higher prices ahead. Insiders at major silver miners have been buying their own stock. Companies like First Majestic, Hecla Mining, and Pan American Silver have seen insider purchases over the past few months. These executives have better information about their industry than anyone, and they're putting their own money to work. Third, examine the options market activity. There's been significant accumulation of call options on both silver ETFs and mining stocks, with strike prices well above current levels and expiration dates in March, April, and May. Someone is placing large bets that silver is going to move significantly higher in the next few months. This isn't retail speculation. The size and sophistication of these trades indicates institutional involvement. When big money takes leveraged long positions, you should pay attention. Fourth, look at the short interest data. The Commitment of Traders report from the CFTC shows that commercial shorts, which are typically the large banks, have actually been reducing their short positions over the past several months. This is unusual because these banks have been persistently short silver for years. Why would they suddenly be covering? The most logical explanation is they see the delivery pressure building and they're reducing their exposure before it blows up in their faces. When the manipulators start covering, it's a strong signal that change is coming. Fifth, consider the industrial demand picture. Silver consumption for industrial applications is at all-time highs and accelerating. The photovoltaic industry for solar panels is consuming over 150 million ounces of silver annually and growing at double-digit rates. Electric vehicles use about twice as much silver as traditional internal combustion vehicles due to all the electronic systems, motors, and charging infrastructure. The EV revolution is just beginning, and silver demand from this sector is going to multiply over the next decade. 5G infrastructure deployment requires significant silver in antennas, circuit boards, and switching equipment. Every 5G tower that gets built consumes silver. The global rollout is still in early stages, meaning this demand source is going to grow for years. Medical applications of silver for its antimicrobial properties continue to expand. From wound dressings to medical devices to water purification systems, silver's unique properties make it irreplaceable in many applications. All of this industrial demand is non-discretionary. These industries need physical silver, and price sensitivity is relatively low because silver represents a small fraction of the total cost of their end products. Meanwhile, on the supply side, mine production is essentially flat to declining. Despite silver prices being significantly higher than they were a decade ago, we haven't seen a major increase in primary silver mining. Why? Because most silver, about 70%, comes as a byproduct of mining other metals like copper, lead, zinc, and gold. When those base metal prices are weak, or when environmental and permitting challenges make new mines difficult to develop, silver supply suffers. We currently have a structural deficit where annual industrial consumption plus investment demand exceeds annual mine supply by over 200 million ounces. That gap is being filled by above-ground stocks, recycling, and drawdowns of exchange inventories. But those sources are finite and declining. Now let me paint you a picture of what could happen starting March 15th if this plays out the way the evidence suggests. The first notice day arrives, and a significant portion of the open interest in March contracts stands for delivery. Let's say 100 million ounces worth of contracts demand physical delivery. The COMEX has about 45 million ounces of registered silver available. They're immediately 55 million ounces short. What are their options? They can try to move silver from eligible to registered categories, but that requires the vault owners to agree and that silver may not be available or willing to be delivered at current prices. They can try to convince some of the longs to accept cash settlement at a premium. Maybe they offer them spot price plus $2 or $3 per ounce to settle in cash instead of taking delivery. Some might accept, but the sophisticated buyers who specifically targeted this delivery cycle won't. They want to expose the shortage, and they want the physical metal. So even if half the delivery demands get cash settled, there's still not enough physical silver for the remaining contracts. The exchange faces a choice: default on contracts and admit they can't deliver, which would destroy the credibility of the COMEX and potentially lead to legal and regulatory consequences. Or let the price run to whatever level is necessary to either attract physical silver or convince the remaining longs to settle. In scenario 2, which is the likely path, silver prices start spiking. Maybe we gap up to $30, then $35, then $40 as the market realizes the shortage is real and physical metal is commanding huge premiums. As the price rises, several dynamics kick in. Short sellers who are holding large paper short positions start facing massive losses. They have to cover by buying contracts, which drives the price even higher. This is the classic short squeeze mechanism. Traders and investors who have been watching from the sidelines see silver making explosive moves and start piling in, creating momentum-driven buying that accelerates the move. Mining stocks go absolutely parabolic because of their operational leverage. A company that produces silver at $15 per ounce cost and sells it for $25 is making $10 per ounce profit. If silver goes to $40, they're now making $25 per ounce, more than doubling their profit margin. That flows straight to the bottom line, and stock prices can easily double, triple, or more in a matter of weeks. This is exactly what happened with palladium miners when palladium spiked from $600 to over $3,000. The mining stocks went up 5 to 10 times. The media starts covering the silver squeeze, which brings in even more retail buying. People remember hearing about the GameStop squeeze, and the idea of retail investors taking on Wall Street manipulation resonates. Social media amplifies the message. Suddenly, everyone is talking about silver, and demand for physical product goes through the roof. Dealers can't keep inventory. Premiums on coins and bars explode to $10 or $15 over spot. The mint struggles to produce enough product. The physical shortage that was already building becomes an acute crisis. At some point, either enough physical silver gets attracted at higher prices to satisfy delivery, or the remaining contract holders accept very generous cash settlement offers, or the exchange implements emergency measures to halt the squeeze. But regardless of how it resolves, silver will have repriced significantly higher, potentially gaining 50 to 100% or more from current levels. Anyone positioned ahead of this move makes extraordinary returns. Those who waited or didn't believe it could happen watch in frustration as the opportunity passes them by. Now let me tell you exactly how to position yourself for maximum benefit with appropriate risk management. This is critical because there are multiple ways to play this with different risk-reward profiles. First, the most conservative approach is physical silver. Buy coins or bars from reputable dealers. American Silver Eagles, Canadian Maple Leafs, or bars from recognized refiners like Sunshine Mint or Royal Canadian Mint. The advantage is you own the physical metal with no counterparty risk. Even if the squeeze doesn't happen on March 15th, you own a hard asset that's a store of value and inflation hedge for the long term. The disadvantage is you'll pay premiums over spot price. You have to arrange for secure storage, and there's no leverage, so your percentage gains will match the percentage move in silver prices. If silver goes from 25 to 40, that's a 60% gain, which is excellent but not as explosive as what you could get with leveraged approaches. Physical silver is appropriate for the core of your position, the money you want to protect and grow conservatively over time. Second option is silver ETFs, specifically SLV or PSLV. SLV is the largest and most liquid silver ETF, making it easy to trade in and out. However, there are ongoing questions about whether SLV actually holds all the physical silver it claims and whether you could ever redeem shares for physical metal if you wanted to. PSLV, the Sprott Physical Silver Trust, is generally considered superior because it's fully allocated, audited, and large shareholders can actually redeem for physical bars. PSLV is a better choice if you want ETF exposure with more confidence in the underlying physical backing. The advantage of ETFs is liquidity and convenience. You can buy and sell instantly through your brokerage account. You don't have to worry about storage or security. You get very close to pure price exposure to silver. The disadvantage is counterparty risk. You're trusting the ETF structure and the custodians. In an extreme scenario where the silver market completely breaks down, there's uncertainty about how these vehicles would perform. ETFs are appropriate for the portion of your position that you want to be able to trade actively and do not need physical possession of. The third option, and this is where the real leverage kicks in, is silver mining stocks. When silver prices move up, high-quality miners with good deposits and efficient operations can see their stock prices move up by multiples. Look at established producers with operating mines and positive cash flow. First Majestic Silver is a pure silver play with multiple operating mines in Mexico. Hecla Mining is the largest primary silver producer in the United States, with mines that have been operating for over 100 years. Pan American Silver is one of the largest primary silver miners globally with operations in multiple countries. Cure Mining has operations in the US and Mexico and has been in business for over 60 years. These companies have the infrastructure, expertise, and resources to ramp up production if silver prices spike, and their profit margins expand dramatically with higher prices. Wheaton Precious Metals and Franco-Nevada are royalty and streaming companies. They don't operate mines themselves, but have agreements to purchase silver at fixed low prices from operating mines. When silver prices rise, they get the full benefit of higher prices while their costs remain fixed. This gives them incredible leverage to the silver price, with lower operational risk than miners. For more aggressive investors willing to take on higher risk for potentially higher rewards, there are junior miners and exploration companies. These are smaller companies with development projects or early stage mines. They tend to be much more volatile but can deliver explosive returns if silver enters a bull market. Examples include Silvercrest Metals, Endeavor Silver, Fortuna Silver Mines, and Mag Silver. These should only be a small portion of your portfolio because the individual company risk is high, but the potential returns can be enormous if both silver rises and their specific projects succeed. The fourth option for sophisticated traders is options strategies. Call options on either silver ETFs like SLV or on mining stocks give you massive leverage. You can control a large position with a relatively small amount of capital. If the March 15th squeeze happens and silver spikes quickly, options can turn small investments into life-changing money. For example, if you buy call options on SLV with a strike price of $30 expiring in April, and you pay 50 cents per contract, you need silver to get above $30.50 just to break even. But if silver squeezes to $45 or $50, those options could be worth $15 to $20 each, a 30 to 40 times return. However, options are risky. They can expire worthless if the move doesn't happen in the expected time frame or if it happens later than your expiration date. You can lose your entire investment. This is only appropriate for money you can truly afford to lose, and for investors who understand options mechanics, Greeks, and implied volatility. If you're going to use options, consider buying calls with expiration dates in April or May to give yourself time for the thesis to play out beyond just the March 15th date. Also consider spreading your option positions across different strike prices and expiration dates to reduce timing risk. Now let me address the risks and what could go wrong, because I'm not here to sell you a guaranteed outcome. I'm here to give you realistic analysis. First major risk is that the COMEX changes the rules to prevent the squeeze. Exchanges have broad power to modify margin requirements, position limits, and settlement procedures when they determine there's a threat to orderly markets. They've done it before. In the 1980 silver squeeze, they implemented Silver Rule 7, which prohibited new long positions and forced liquidation. They could do something similar now if they suddenly raise margin requirements to force leveraged longs to sell, or if they mandate cash settlement at current prices. The squeeze gets killed before it really starts. Your mining stocks and options could drop sharply as the thesis falls apart. This is the single biggest risk to the squeeze scenario. The system has powerful tools to protect itself, and they won't hesitate to use them if major banks face insolvency from silver short positions. Second risk is coordination among the large players to defuse the situation. Behind closed doors, regulators, exchange officials, and the major banks could negotiate deals with the large longs demanding delivery. Maybe they offer very generous cash premiums to settle without taking physical delivery. Maybe they arrange for silver to be sourced from central bank reserves or strategic stockpiles that aren't publicly known. Maybe they work out delayed delivery schedules that spread the demand out over months. If the potential squeeze gets negotiated away, the explosive price move doesn't happen. Third risk is timing. Maybe the squeeze happens, but not on March 15th. Maybe it takes until April or May or later in the year for the dynamics to fully play out. If you're positioned in options that expire in March or April and the move comes in June, you lose money even though you were directionally correct. Timing markets is incredibly difficult, and even with compelling fundamental analysis, the exact catalyst and time frame can be unpredictable. This is why having a mix of physical, stocks, and longer-dated options reduces timing risk. Fourth risk is a broader market crash. If we experience a major sell-off in equities and a liquidity crisis in financial markets, everything tends to get sold initially, including precious metals. We saw this in March 2020 when even gold and silver dropped despite being safe havens, because forced liquidation to raise cash overwhelms everything. If the stock market crashes hard, silver and silver miners could get taken down with it initially, regardless of the fundamental squeeze setup. Eventually, the safe haven bid would reassert and silver would recover strongly, but there could be a painful drawdown first. Fifth risk is that my analysis is simply wrong. Maybe the delivery demands aren't as large as reported. Maybe there's more silver available than the public data suggests. Maybe the industrial demand story is overstated, or mine supply increases faster than expected. Maybe the manipulation allegations are exaggerated and the market is functioning normally. I believe the evidence points strongly toward the squeeze scenario, but I could be wrong, and if I am, your positions could lose money. This is why position sizing and risk management are critical. Given these risks, here's how I'd recommend structuring your positioning. Allocate no more than 10 to 20% of your investable assets to this theme, unless you have very high risk tolerance and strong conviction. Within that allocation, put 50% in physical silver for long-term holding regardless of short-term price action. Put 30% in a mix of quality mining stocks and royalty companies that you can hold for months or years if needed. Put 15% in silver ETFs for liquidity and tactical trading. Put only 5% in options, and only if you truly understand them and can afford total loss. This structure gives you meaningful exposure to benefit if the squeeze happens, while not risking your entire financial well-being if it doesn't. You're positioned to make significant money, but not positioned to be destroyed. That's how professionals approach high conviction but uncertain timing situations. You want asymmetric risk reward where your potential upside is much larger than your downside risk. Let me also give you some price targets and timeframes to think about. If the squeeze happens, I believe silver could realistically reach $35 to $40 within 4 to 8 weeks of the initial spike. That's a 40 to 60% gain from current levels around $25. Mining stocks could easily double or triple in that scenario given their leverage. If the squeeze is particularly severe and goes beyond what I'm expecting, silver could spike to $50 or higher in a blow-off move before settling back. History shows that commodity squeezes often overshoot to the upside before finding equilibrium. On the flip side, if the squeeze doesn't materialize or get suppressed by exchange intervention, silver could drift back down to the $22 to $23 range, where it found support previously. That's about a 10% downside from current levels. Mining stocks might drop 20 to 30% if the thesis fails. That's why the risk reward is attractive. You're risking 10 to 30% to potentially make 50 to 200% or more. Those are odds worth taking with appropriately sized positions. Beyond just the March 15th catalyst, I want you to understand that silver is in a long-term structural bull market regardless of this specific squeeze. The fundamentals are incredibly bullish. Industrial demand is growing faster than supply. The energy transition requires massive amounts of silver. Investment demand is awakening as people seek inflation hedges. Central bank money printing continues globally. The gold to silver ratio at 90 to 1 is historically extended and likely to compress. All of these factors suggest that silver is going much higher over the next several years, whether the March 15th squeeze happens or not. So even if you miss the optimal entry or the timing is off, staying positioned in silver for the longer term makes sense. This is not just a one-day trading event. This is a multi-year investment theme. The March 15th deadline is simply a potential catalyst that could accelerate the timeline dramatically. If it doesn't trigger immediately, be patient. The fundamentals are working in your favor, and the longer the manipulation continues, the more explosive the eventual resolution will be. And what I want you to do right now is make a decision. Are you going to take action on this information, or are you going to watch from the sidelines? If you're going to act, do it strategically. Don't throw all your money into one position. Don't use leverage you don't understand. Don't invest money you need for living expenses. But do something. Buy some physical silver. Pick up shares of a quality miner. If you understand options, maybe place a small speculative bet. Get some skin in the game so that if this plays out, you participate in the wealth transfer that's about to occur. Share this video with everyone you know who cares about building wealth and protecting against manipulation. The silver squeeze story is one of the most important financial events happening right now, and mainstream media is barely covering it because the establishment does not want retail investors figuring out what's happening. Your friends and family deserve to know. Post this everywhere. Start conversations. Build awareness. The more people who understand and position themselves, the more pressure on the manipulators and the more likely the squeeze succeeds. Subscribe to George Vance Live right now and turn on all notifications. March 15th is approaching fast, and I'll be providing real-time updates as the situation develops. We're going to track the delivery data, the price action, the warehouse inventory changes, everything you need to know to make informed decisions. This is going to be a wild ride, and you want to be fully informed every step of the way. Drop a comment below telling me your silver strategy. Are you buying physical? Loading up on miners, trading options, just watching and learning? Let me know what you're thinking and what questions you have. Let's build a community of informed investors who help each other navigate this opportunity. March 15th, the deadline that changes everything. The day when decades of silver market manipulation could finally get exposed. The moment when paper silver and physical silver diverge so dramatically that the system breaks. This is your opportunity to be on the right side of that break. The evidence is compelling. The setup is extraordinary. The timing is now. Don't let this pass you by and regret it for years to come. This is George Vance Live, giving you the truth about the silver market that the bullion banks don't want you to know. Position yourself wisely, manage your risk, and prepare for what could be the most significant precious metals event of this decade. March 15th is coming whether you're ready or not. Make sure you're ready. Until next time, stack silver, stay informed, and never trust the paper price when the physical market is screaming shortage. The squeeze is building, and you have a choice about whether you profit from it or watch others get rich while you stood on the sidelines. Choose wisely.